Hi, I'm John Rutley. After months of denial, the Fed finally threw in the towel on transitory inflation and unveiled their new taper program. Just in time, too. Consumer prices have increased by almost 7% in the past year. Businesses are struggling to fill 10 million vacant positions. 4.5 million people quit their jobs last month, and unit labor costs are 9.6% higher than they were a year ago. The taper is the Fed's promise to slow down the printing press by reducing the $120 billion worth of bonds they've been buying every month to only $105 billion next month, $90 billion the month after that, and so on until they stop buying bonds altogether sometime next year. Or so they say. Fact is, they can change their mind and scrap the taper program at any point along the way, which is exactly what I think they're going to do. Buying bonds is a tough habit to kick. The Fed has been sucking up bonds for 13 years since the global financial crisis. In Fed speak, they call bond buying quantitative easing, or QE. I call it printing money. When COVID hit, QE shifted into overdrive. In the past 20 months, the Fed has bought $5 trillion of bonds and mortgage securities and effectively nationalized the bond market. Today, the Fed owns more than 20% of all of the treasuries and mortgage-backed securities that exist. The other central banks have been doing the same thing. All told, the Fed, the ECB, the Bank of England, and the Bank of Japan have purchased a staggering $23 trillion of assets since 2008. When the elephant's in the bathtub, we all get wet. These massive purchases have pushed asset prices into unexplored territory and interest rates to historic lows. Existing home prices increased by 16% in the past year, and the S&P 500 and NASDAQ were both up by more than 40%. But it's long-term inflation that really matters, because over time, inflation distorts every economic decision and eats away at the value of our savings and our stock of capital. Long-term inflation doesn't depend on last month's CPI report or on how many ships are waiting to unload their containers in Long Beach. It depends on how much money the Fed decides to print over the next decade or more. Long-term inflation is difficult to predict because it will be driven by actions the Fed has not taken yet in response to the next set of economic problems we face. That means long-term inflation will depend on exactly who will be sitting in those big leather chairs at Federal Reserve Board meetings. President Biden will decide who sits in 5 out of those 7 chairs in the next few months. He has already filled 2 of them by reappointing Jerome Powell as chair and Lael Brainerd as vice chair of the Board of Governors. So, who will President Biden choose to fill the remaining 3 chairs? He'll pick the names from the short list of candidates he's handed by his advisors, like every other president. That makes it important for investors to know who his advisors are. Biden's advisors come in 2 flavors. One group, led by Janet Yellen and Jared Bernstein, are the same prominent, a little left of center mainstream economists that you would have found in the Obama or Clinton administrations, at the Brookings Institution, or arguing with me on CNBC. This bunch is easy to figure out, both because we've already seen them work and because I know most of them myself. They like higher government spending. They like higher tax rates on capital income. They like bigger social programs, and they worry a lot less about inflation than I do. The second group are the modern monetary theory evangelists who believe debt doesn't matter and that the Fed can print its brains out with little consequence. They are not mainstream anything. This is the group I worry about. We don't know the names of the new Fed governors yet, but we can be sure that all 5 of them will think it's a good idea to let inflation run a little hotter for a little longer than I would. Based on everything I know about the current and prospective Fed governors, I believe the Fed is going to throw the taper out the window the first time they see a big drop in stock prices or home values or a disappointing jobs report. They'll just say they're data dependent and that the data are telling them to give the taper a timeout until the economy gets past whatever rough patch they think we're in. We may not have to wait long for the Fed's first gut check. The new Omicron COVID variant has spooked investors. If prices keep falling or the economy slows, we'll see very soon whether the Fed's actions are as tough as their words. Bottom line is, I just don't believe the Fed board members have the stomach to bring the taper in for a landing, let alone sell the $9 trillion worth of bonds they're already sitting on. That means inflation is going to be around for a long time. This is extremely important for investors. In my next post, I'll talk about why inflation has such big impacts on asset prices, why you should shift a portion of your portfolio to real assets, and why you should do it now. Thank you for spending time with me on this important topic. I hope the discussion is useful to you. As always, I welcome your comments and invite you to join the discussion with me and my extraordinary group of subscribers. I'm John Rutledge.